Hey everyone, and welcome to the first Lima market report for 2026. Well, last year was certainly fun. Overall, we had a positive U.S. financial markets, although it was not without periodic volatility. For long-term investors, the year reinforced the importance of maintaining a well-defined, diversified strategy aligned with a strong financial plan. And even aimed at short-term market fluctuations, the S&P 500 ended the year with an appreciation of about approximately 16 to 18%. Performance was supported basically by solid corporate earnings growth, the resilience of the U.S. economy, and strong contributions from large technology companies. Throughout the year, markets reacted to sensitivity to inflation and employment data, as well as signals from the Federal Reserve, leading to occasional corrections that did not disrupt the overall positive trend. Pretty much a normal year. The NASDAQ Composite delivered an even stronger results, rising close to 20% last year. As expected, the index benefited from its heavier concentration in growth in technology companies, particularly those tied to AI, artificial intelligence, semiconductors, and innovation. And at the same time, the NASDAQ really experienced greater volatility, with higher potential returns typically come from greater short-term fluctuations. On the fixed income side and the bond side, the Bloomberg Aggregate Index posted a meaningful recovery with estimated returns between 6.7 and 7.2 for the year. This performance was driven largely by gradual decline in bond yields as markets began pricing in interest rate cuts in more controlled inflation environment. For those who subscribe to a well-diversified portfolio, fixed income once again played an important role in income generation and volatility reduction. The primary source of market volatility of 2025 were the Fed, inflation, the trajectory for inflation, the labor market conditions, and geopolitical developments. These factors continue to influence investor sentiment, underscoring the importance of discipline and long-term perspective. Looking ahead into 2026, guess what? Expectations point to a more balanced environment with potentially more moderate returns compared to last year. For equities, we're looking at projections suggesting lower balance among growth, income, and capital preservations. As you know, money market accounts and savings do not earn as much as they did the same time last year. So to put it all together, 2025 reinforced the value of planning and diversification. Looking ahead into 2026, the recommendation remains stay focused on long-term objectives, avoid decisions driven by short-term market movements, and they will come, and really maintain a disciplined approach to managing risk and opportunity. Well, that's our report for the week. For a deeper analysis, charts, updates, and throughout the week, please visit MRAadvisory.com and have a great week. And thanks for tuning in.